Welcome back, investors, to Ticker Time News. I'm Adam. Thank you for joining me for the After Hour Show. We're here to talk about the market, stocks, crypto, but most importantly, what's on your mind. If you have a question, leave the ticker symbol and your question in the comments, and we will go over it live during the show. Okay, just a few quick announcements to run through, and then we will dive right into it. Number one, remember the markets are closed on Friday, December 24th, for the Christmas holiday. And you requested it, so I'm going to set it up, a Discord server for everyone. And then the third thing is Webull. If you have not set up a Webull account, Webull is offering 5 free stocks for new account holders. All you have to do is click the link in the live chat or the second link in the description of this video, tickertimenews.com/Webull. Sign up for an account, deposit any amount, $5, $10, it doesn't matter, any amount, and then you get 5 free stocks. That is free money, folks, for the holidays. It's a great offer from Webull. Their platform is more sophisticated than the Robinhood app. It's got charting features. It's just way more sophisticated than your regular oversimplified Robinhood app. So do take advantage of that if you have not set up a Webull account yet. This offer ends on December 23rd, so you only have until Thursday to claim this these 5 free stocks. All right, the market today, man, it was mixed. There were some green ones, some red ones, all in between. One of my new favorite SPACs, Box, ticker symbol BOXD, it was up 11.2% today. I hope you guys took advantage of that. Shiba was up today, surprisingly, up 10%. Tesla was up today, 7%. We'll talk about Tesla in just a moment. And then we've got a few other ones that were up here today, but not a lot of real big movers in the on the chart today. Cardano was actually up 4.7%. So cryptocurrency is kind of making a bit of a comeback. We'll also look at Bitcoin too, because that's in the green today. At least last time I checked, it was in the green. So all right, let's just get into this. First thing first is the S&P 500 and the market. Okay, I'm gonna do my opening monologue. We can dive into your questions, or I do have some deep dives on CarMax, on Paychex, and another one for you. But for the S&P 500, I use the ticker symbol SPX in TradingView to track the S&P 500. And you see a nice green candle again today. It is up above that 50-day moving average. It is getting close to that marker here, which would be last Thursday's high. This blue line I put here on the Sunday Catalyst Watch video. If we cross this line, then this is a very bullish development in the market and not just a fake out, right? There could be some real strength behind, real momentum behind the market moving up, leading into the Christmas holiday and maybe for the rest of December. So let's talk about the overall market and what I saw today. So stocks did extend gains for the second session in a row today, with the Dow Jones climbing more than 250 points, the S&P 500 rising 1%, and the Nasdaq jumping 1.2%, buoyed by an upbeat economic data. Updated figures showed the U.S. economy expanded by an annualized 2.3% rate in Q3, above second estimates of 2.1%, and consumer confidence improved more than expected in December, while existing home sales, that rose for the third month in November. President Joe Biden also reiterated on Tuesday that the government will not bring back strict lockdowns and that it will purchase 500 million at-home COVID tests that will be free to Americans. If you divide that out by the number of U.S. citizens, you get about 4 tests per citizen, per household in the U.S. You get about 4 tests per household. So that's pretty significant, isn't it? On the fiscal policy front, President Biden also said that he and Senator Joe Manchin were, quote, going to get something done, end quote, on the $2 trillion Build Back Better social policy. Now, 11 all 11 sectors finished the day in positive territory, with consumer discretionary sector up 1.7%, ending in the lead, while 8 of the remaining 10 groups recorded gains of under 1%. So again, it wasn't a big move today in the market for the overall indices. Now, the top weighted technology, it was up 1.3%, and it finished right behind the discretionary sector, while industrials were up 0.3%, utilities 0.4%. They finished at the bottom of the leaderboard. The discretionary sector drew support from gains in most components. Through Tesla, we'll talk about Tesla in a moment. They were up today. Tesla was up, and it was a big driver of the outperformance, rallying back towards its 50-day moving average of 1132. After CEO Musk said that he has sold enough stock. That's right. Elon Musk said he has sold enough stock to satisfy his obligation of 10% of the shares. Now, Tesla's outperformance masked relative weakness in stocks like Amazon. While CarMax fell past its 200-day moving average. That was a tough one, down below 132. And its lowest level since early October, after its Q3 beat was marred by contracting margins. So while it did have some revenue, its margins were shrinking, and they have been shrinking. And we're going to do a deep dive on CarMax to talk about that. As for technology, the influential group received support from gains in its largest components like Apple, Microsoft, Visa, and MasterCard, which masked relative weakness among chip makers. Now, Treasuries, they climbed with the 10-year yield slipping 3 basis points to 1.46%. Crude oil, it rose 2.3% to end up at 72.77 a barrel. Now, that is revisiting its high from last week. And like you see on my screen here, the S&P 500 is also getting close to its high that it made last Thursday. All right, and that's where we want to see the market. We want to see it up here above this blue line again. All right, real quick, let's check in on Bitcoin, then Ethereum, BTC, USD on the chart there. Let that load, so we're all looking at the same page here. Now, we have a nice green candle from yesterday, up 4.2%. It brought it up above its 200-day moving average, but it ran into resistance at its 21-day moving average. Today, though, it's kind of hugging that 21-day moving average. It is just hugging and just holding on to it and barely moving. And when I started the video, I said Bitcoin was up just a little bit. Now it's down just a little bit, 0.08%. So it's basically been flat, just up and down on that 21-day moving average today. And it's at 48,873 right this second. All right, Ethereum. Well, one more thing to say about Bitcoin. And I've been saying it now for weeks, since it dipped below or got close to that $50,000 mark. That is a very important level, and it will be resistance for Bitcoin unless it has a humongous momentum push. And what do we need to see for a momentum push? We need to see volume twice as high as average volume. And right now, today, volume was at about 9.9. Okay. Average volume right now today is 16.6. So we're still under average. And that's one reason why it's been flat today. And relative strength right now is at 44.1, and we need to get that above 60. Really, to get Bitcoin to kick into gear with momentum, we need RSI above 60, and we need the volume to at least be in the double digits, 15, 16, 17 even. And then we could have some real momentum to get above that $50,000 mark. It's going to be a tough one because it holds a lot of psychological power over investors and traders alike. So just keep your eye out for that. The closer we get to it, the harder it's going to be to break above it. But I do believe that once we break above it this time and we back test that $50,000 level, we could hold above it, which would be very positive for Bitcoin. I almost like to think of this as a bit of a self-fulfilling prophecy. You know, a few months ago, when we were in the 60,000 range, I felt personally that Bitcoin could easily get to 75,000. And of course, there were tons of YouTubers calling for 100,000 by the end of the year. Well, we're not going to reach that. We're not even going to reach my goal of 75,000. And when I say self-prophecy, it's almost like we were all so wrapped up in Bitcoin getting to these levels that we just lost the plot of how Bitcoin operates. So I do believe that next year we will see a nice rally for Bitcoin. I still do not believe, even though Bitcoin is hugging down here at the 48,000, 49,000 level right now, I still do believe that Bitcoin has not finished its bull run for this cycle. I have not been able to shake that, and it may be a Bitcoin bias that I have towards it. So it's just something to think about, but I do believe that 69,000 is not the top for this bull run for this cycle for Bitcoin. I do think it's got room that it can go, but we're gonna have to wait till next year to see those levels that we all thought Bitcoin could get to. Now, over the long term, this gap right here, this area, let me bring the chart back in. This time period, 2021, this was your year to buy into Bitcoin. If you have not bought Bitcoin, this right here was your year to do it. 2021, when we look back a year from now, 5 years from now, we are going to feel like, wow, 2021, I wish I could have bought into Bitcoin when it was at 48,920, like it is right now. I really believe that when we look back at 2021, we're going to feel like that was the year to buy Bitcoin. It was flat a lot of the year. It had many low points for many months on end where you could have dollar cost averaged into Bitcoin and been in at a reasonable price. I mean, at $48,920, you know, $75,000, that's a big difference. You even go to $100,000 and that's an even bigger difference. But enough of looking at this as a big picture. Let's go look at Ethereum and see how Ethereum is performing today. So that's ETHUSD on the chart. Excuse me, I've got something in my eye, and it's been bugging me now for about an hour or so. All right, so here we have Ethereum. It's down 0.5% today. It was up above $4,000 today, and I thought, wow, is today the day that Ethereum is going to get above 4,000 and be able to stay above it? Now, as you can see here, it ran up to its 21-day moving average and it found resistance there, just like on Bitcoin. And that's typical, right? When you're in a downtrend or you're moving sideways, your short-term averages can very easily act as resistance, especially when you're trying to make your way back up, but you don't have that much momentum behind you yet. So with Ethereum here, hitting its 21-day moving average, it's at 39.95 right now. $5 below that $4,000 level. It got as high today as 40.76. So that's a good sign. And if we look at yesterday it got as high as 40.64, right? So that's an improvement. Its high today was higher than yesterday, which was higher than the day before. So 3 good days in a row here for Ethereum. Now, Ethereum didn't lose as much as Bitcoin did. Ethereum is relatively flat compared to what Bitcoin did when it fell. So its pattern is holding nicely. All right, I get a lot of questions for this one, and it's Alibaba. Now, BABA. I was going to do a segment, a deep dive on Alibaba, just because I get a lot of questions about Alibaba, but I decided not to. Okay? Look at Alibaba for the year. We'll get 2021 on here. So what's on your screen is 2021 for Alibaba. Let me put another vertical here above my head for that earnings over here from February. Wrong button. Did that yesterday too. Okay, so here's Alibaba. I was going to do a deep dive on them, but just as soon as I started to do that deep dive, I noticed something that was glaring. And in my Catalyst Watch video on Sunday, which is the most important video I do all week long, and it has been on fire this week. My Catalyst Watch video from this week has nailed so many companies. It makes me feel good, right? You feel good when you get things right. But I don't always get things right, so don't confuse me with that. But with Alibaba, the CCP, right? The Chinese Communist Party, they have just got a hold on Alibaba, and they are squeezing them and holding them down. And I talked about on the Catalyst Watcher video that for Alibaba to break this trend, it would have to show that the CCP no longer has a hold on them. And that just isn't the case. Chinese regulators have actually suspended their cybersecurity deal with the Alibaba Cloud Division. And this is according to a report in Reuters. Or Reuters, sorry, Reuters. My apologies. So, as long as the CCP has this hold on Alibaba, it's not worth investing in. So, I hope I'm making this clear. They were down 4.2% today. That's your signal. If the CCP gives their blessing to Alibaba, which I do not see that coming anytime soon, that would be a signal that Alibaba at these prices is a value play. But they still have the hold on them. So right now, for me, out of it. Not in it, won't touch it. Okay, let's look at another company that I really like, Thor Industries. Ticker symbol is THO. Now, we did a deep dive on Thor after their earnings. Okay, look, this is 2021 for Thor. They've basically moved sideways all year. They are actually, I believe, underwater for the year. Oh, no, they're up 6.1% for the year. So barely above water. I personally think the market is getting Thor Industries wrong. Totally wrong. The Thor Industries builds recreational vehicles, motorized and towables. The RV industry is hot right now, just like the boating industry is hot right now. And those two industries overlap significantly. And the market is really missing the boat on the RV industry and the boating industry. Those two industries, they are selling more product than they have in years. But more importantly, they are selling at higher margins than they have in their history. Higher margins. That means for every dollar invested, they are bringing back a bigger return. But the market is not rewarding them for this. So since the market's not going to reward them for it, Thor Industries is taking it into their own hands to reward their investors. Thor Industries announced the repurchase of $250 million of common stock. This is a share buyback program. We've talked about this a lot. This is one way a company can reward its investors. When a company buys back shares, that helps the stock price to appreciate. It's just like when you're buying shares of a company and then everybody else is buying shares of a company and the stock price goes up, right? Simple economics. So looking good. Just came across the wire here. Nikola is up 5.6% on tweet showing first customer delivery. Oh, Nikola was in the news last year for all the wrong reasons. Its CEO did terrible things. And let me just put Nikola up here for a second. NKLA. I have not looked at their stock in a while, but I know they've been trying to turn things around. So this is 2021 overall downtrend. If we look here, it looks like they have a bottom at about, maybe we could call it $9, $9.25, somewhere in there. It's got a bottom where when it gets down there, it bounces. But if this report is true, that Nikola has actually made customer deliveries, that's a pretty big deal. So, yeah, something to watch. I know it's a company that we've all lost faith in. I don't invest in, but I just saw that news come across the wire, so I thought it would be interesting to take a look. Yeah, so I have a screen off to my left here, and every bit of news that comes in from all the different companies across the spectrum of the market. Whenever there's news, it pops up. So it's constantly moving. It moves quicker than a Twitter feed. All right, here's another one to talk about. They were in the news today, and that's Darden Restaurants. That's the owner of Olive Garden. Yes, they own Olive Garden. Ticker symbol is DRI. Now, they were upgraded to a buy, and they have a price target of $165. Now, they've been bouncing around in this channel, and they have been locked in this all year long. Literally, since the beginning of March, they have been in this channel moving sideways. And it's because every time we get news that the economy is doing better and the economy is open and more people are participating in the economy by going out, not staying in, but by going out, and we get news that restaurants are doing better, their stock goes up. Then we get news that restaurants are doing bad, and then the stock goes down. So it just keeps bouncing. Now, I find this price target of $165 interesting because it's all-time high that it reached. When would this have been? Hold on. We got to go back in history here a little bit. No? Where did it hit that? Okay. There must be a candle here around earnings that I'm not. There it is right there. September 23rd on earnings, it gapped up and it reached a new all-time high. That's right. We covered this. We talked about that. This gap up right here on earnings, the vertical line is kind of hiding the hole right here. There's a gap up right here, and this is where they reached their new all-time high of $164.28. Now remember, the price target is $165. So we're only pennies away, right? A few quarters away. What, 73 cents? So their all-time high that they hit in September is 73 cents away from this price target. So let's measure from 165 up one more. All right, and then we'll measure where we are right now, which is the blue right there. So it's about a 12% move. There's a 12% difference there from where the stock is right now. And the stock is just hanging on to its 200-day moving average. It's finding resistance at its 50-day moving average. And it's because they're in a very unique place on the chart where all of their moving averages are a few bucks apart. So they're all kind of meeting there in one place. So it's either going to break past this 50-day moving average, or it's going to continue to move sideways, maybe towards the downside a little bit. But I think that it's going to have enough momentum to continue to at least move up to the top of its channel, which is at $150. Okay, so interesting. An upgrade to buy with a $165 price target. Again, that is a 12% upside. Okay, let's do a couple of deep dives here on a couple of companies. Just give me one quick second. All right. I want to talk about BRZE. Okay. Ticker symbol is BRZE. Now, BRZE has not been public very long. We talked about BRZE on our Catalyst Watch video today. And when we did that on Sunday, the price was here. Okay. It opened down here on Monday. So if we measure, because if you would have bought the Monday dip and rode to the top, that was a 42.7% move to the upside based on earnings. They had a tremendous earnings. So let's go deep on them. All right. So let's get our thoughts together here. And let's do a deep dive on BRZE, ticker symbol BRZE. Now, BRZE, we talked about them in our Catalyst Watch video on Sunday, and I said this company was intriguing. And I also talked about the chart setup. Now, if you would have bought the bottom on Monday when the markets opened and rode this thing to the top, that would have been a 42.7% gain in 3 days. In 3 days, 42.7% run to the upside. Now, BRZE, on the heels of its high-flying IPO last month, and you can see this clearly on the chart, BRZE reported quarterly numbers for the first time as a publicly traded company, and the results were quite impressive. The customer engagement platform provider, they crushed Q3 top and bottom line estimates while also issuing upside Q4 guidance. That's what I love to hear from companies during earnings report. An upbeat guidance, a guidance where they are saying we are going to do better next time. Those are the earnings that really move stocks. Now, this is illustrating that the demand for its multi-channel marketing tool remains robust. BRZE's strong performance is what I would say rekindling the original excitement that caused its IPO to price well above expectations at $65 versus the original $55 to $60, and opened for trading with a 34% gain. That initial buzz was primarily due to its positioning as a digital transformation play and the accompanying high growth rates. What BRZE's report served to accomplish is to remind investors of its compelling growth story as companies continue to invest in their customer experience applications. While the onset of the pandemic may have instigated, may be the best word, instigated companies to begin or to expand their omni-channel journeys, that transition is still playing out and it's evolving. This can be seen across a variety of BRZE's metrics, including in acceleration in revenue growth to 63% from 55% just last quarter, fueled by a 48% jump in new customers to 1,247. Even more encouraging is the company's growing ability to attract large enterprise customers with $500,000 or more in annual recurring revenue, ARR. As of October 31st, the number of large customers that fall into this, I would say, bracket increased to 97 from 68 in the year ago period. Another figure that really highlights the healthy demand environment and the success of BRZE's land and expand model is the dollar-based net retention rate of 126%, bolstered by a combination of strong renewals and upsells. That metric is up 200 basis points year over year. One of the few blemishes is that BRZE is not yet profitable, posting a Q3 loss per share of 16 cents. But there's even good news in to share on this account. As company grows, as the company grows, and it grows in size, it's achieving economies of scale within its technology cost structure, especially across its database and hosting expenses, creating a catalyst for margin expansion, the opposite of what CarMax is doing. Additionally, BRZE is realizing personal expense efficiencies due to an improved alignment of management structures. The end result is that non-gross or non-GAAP gross margin climbed substantially to 70.3% from 63.8% in the year ago quarter, bringing the company closer to break even. Looking ahead, the outlook is bright, with BRZE forecasting Q4 revenue growth by about 53%. There is plenty of runway ahead, with the company estimating a total addressable market, or TAM, of $16 billion in the US alone. The main concern and risk is, of course, its valuation, which is quite rich with a forward PE north of 20 times. If the rotation out of expensive growth stocks resumes, BRZE could fall out of favor again, as we saw in the wake of its IPO. Just look at that downtrend on the chart. However, though, I would point out, let me rephrase that. However, I would point out that its business has momentum on its side, and the overall fundamental picture is bullish. So, what do you think about BRZE? I know it's a new company, hasn't been on the market long, and I'm sure many have not done their due diligence yet on BRZE. So, let me just give you a quick synopsis here of BRZE. So, it says that BRZE operates a customer relationship management platform for mobile applications. Its application combines messaging, audience segmentation, analytics, and user support in a single integrated solution. It operates through cloud-based customer engagement platform, subscription segment. The firm offers push notifications, email, in-app messaging, and newsfeed services. Okay, cool. The company was founded in 2011, so it's not that old. Okay, cool. So there's a quick little synopsis there of BRZE and what they do. All right, I do want to talk about PAYX next. PAYX. Give me a quick second here. All right. PAYX. Let's pull up the whole year here. All right. Now, like I said on the Catalyst Watch video about PAYX, is PAYX it has a very similar motion as the S&P 500, meaning that if you line the two charts up together, they're going to look relatively the same. Of course, there are some differences. The S&P 500 doesn't have earnings that can make holes like the hole we have here from today's earnings or from the hole from last quarter's earnings. Okay, so PAYX. Now, PAYX is a phenomenal company. When I had a small business that I started, I used PAYX, and it takes oh my goodness. When you start a business, you know, you have many hats to wear, right? You have to be the finance department, the HR department, management. You have to, be the laborer you wear every hat when you start a company. Everything that the company has to do, you have to do it. One thing that PAYX does, and it does it at a very affordable rate, it's based on how many employees you have, is that they take the whole HR, paychecks, all that headache, all that work off of your plate. You basically say, this person worked this many hours, that's what they get paid. Or if you have somebody who is on a salary, you just say, yep, that person worked this week. That's simple, right? They keep track of everything. They even pay your tax bill because they take that money out, right? So as a small business owner, your bank account is connected to PAYX, and when it's payday, right? Well, PAYX has already taken the money out of your account. They've already taken all the taxes that you have to pay for those employees. They've already taken that money out of your account too. So every quarter, you don't have to worry about sending the government, the IRS, your bill that's due for your employees. PAYX goes ahead and does that for you. So they literally they become a small business's HR department, and it's relatively inexpensive compared to other things a small business owner might engage in. So I really like PAYX personally. I've used them. I love them. I'd recommend them to any small business, medium business. If you own a business, PAYX, and you have an employees, it takes the headache away. It really does, and it really simplifies things. So PAYX now, looking at the stock, which is a little bit different than what I was just talking about. PAYX, ticker symbol PAYX, PAYX. It's cashing in on a solid quarter in which it beat on earnings by its widest amount in 5 years and continued to grow revenue at a nice pace. It's a human capital management, or HCM, software provider. That's technically what they are called. The primary customer for them is going to be a small or medium-sized business, SMBs, as we'll call them. So PAYX was significantly disadvantaged by the effects of lockdowns and COVID-19 restrictions last year. However, over the past 3 quarters, as vaccination rates and treatments for COVID-19 improved, PAYX returned to double-digit revenue growth while outperforming earnings estimates at an accelerated rate. Part of PAYX outperformance in Q2 and over the previous 2 quarters was driven by a rapid digital transformation undertaken by SMBs. Remember, that's small, medium businesses, largely as a result of the pandemic. Companies are increasing their focus on moving towards digital platforms, as well as seeking HR advice and tools to attract and retain talent. That's one of the biggest reasons for using a service like Paychecks when you're a small business owner. When you hire somebody and they're doing a super awesome job for your company, you want to keep them around. And the best way to do that is to offer them the best perks that you possibly can. And Paychecks helps a small business to do that. This helped produce solid revenue growth for Paychecks of 12.7% year over year to 1.11 billion dollars in Q2. A good continuation of Q1's back in August, 16.8% growth, and Q4's back in July, 12.5% growth in those quarters. Strong growth in checks per payroll and increasing worksite employees have also contributed nicely to Paycheck's solid top line in recent quarters. Amid a broader return to the worksite, SMBs become burdened by many aspects of HR management that can be alleviated by a professional employee organizer or PEO. As a result, Paycheck's PEO and insurance segment continue to grow well, up 11% year over year in Q2. Also, although many SMBs had to temporarily close last year, well, man, oh man, last year, right? While grappling with a sustained tight labor market, Paychex clients, well, their retention remained near record levels in Q2, a testament to the resiliency of SMBs. Looking ahead, Paycheck raised its fiscal year 22 earnings and revenue guidance. Advanced or not advanced, but adjust. And that's up from 12 to 14%. And sales growth of 10 to 11%. And that's up from 8%. Overall, Paychex is growing comfortably, even while companies continue to deal with difficulty finding and retaining workers. The company's client retention is a notable standout in the quarter. Its metrics are especially pronounced when stacked against those of Paychex's much larger competitors. Automatic data processing, ADP, right? They're a big one in paycheck processing. They saw a modest drop off in its small business division in Q1, and that was in September for them. It also assumed a slight decline in its retention outlook for fiscal year 22, but not for Paychecks. Bottom line, even given the increasing uncertainty around COVID, Paychecks is situated nicely with key macroeconomic tailwinds such as the digital transformation at its back. So, what do you think about Paychecks? If you were a small business owner, is this a service that you could see yourself, or is it worth investing in? I say both. All right, give me a quick little break here, and then we're going to jump into CarMax. CarMax KMX. Look at the ride that it's been on. All right. Let me move these two. One more line here to move out of the way. Okay. I'm going to get 2021 on here. One more line here for earnings back in April. All right. So CarMax has been choppy, but it has been moving up. So year to date, CarMax is up 35.3% year to date. So it's been moving up. It could be a lot higher, but it's not. Recently, it's taken a dive and it's down over 6.5% right now today. So CarMax, ticker symbol KMX, their shares appear to be stuck in reverse today, even though the company posted a decent earnings beat and tremendous revenue growth for Q3. Excuse me there. Heading into today's earnings report, shares were already trading towards post Q2 lows back in August, below that 200-day moving average. The used vehicle retailer shook investors by missing on earnings by a wider margin than expected, even while the supply of new cars remained tight. With dealer inventories remaining at historically low levels as of late October, and that's according to AutoNation, ticker symbol AN, the stage was set for CarMax to rebound nicely from last quarter's fairly disappointing results. However, despite returning to solid earnings upside and accelerated revenue growth, KMX or CarMax missed on gross margins for the fifth straight quarter, despite a rather significant increase in profit per vehicle, I might add. Digging a little deeper, CarMax's 7.7% adjusted EPS growth year over year, a nice reversal from Q2's 3.9% drop, primarily stems from a combination of stellar revenue growth and higher profit per used and wholesale vehicle, since gross margins fell year over year for the second straight quarter. Gross margins now sit at just 9.8%, a decline of 240 basis points year over year. Revenue growth was a standout, however, leaping 64.5% year over year to $8.53 billion in crushing estimates. In addition, CarMax was lapping a stronger quarter of 8.2% growth comps compared to 2022, compared to quarter two. Jumped ahead of myself again. I think it's the word leaping. Whenever I use that word leaping, I always jump ahead. So when compared to Q2, so CarMax was lapping a stronger quarter of 8.2% growth compared to Q2, when it was lapping just a 3.3% growth, yet only grew revenues by 48.7%. Also, Q3 tends to be weaker than Q2 for the used car market. So the stellar growth is a good sign that demand levels remain high. Another bright spot in the quarter came from vehicles purchased by CarMax, which soared 91% year over year to 383,215 at a time when new vehicle inventory remains tight. It is vital that CarMax continues to purchase an increasing number of used vehicles to capture elevated demand in the used car market. CarMax may also be advantaged by competing car buying service Carvana, ticker symbol CVNA, having to meter cars bought during Q3. Given the strain placed on its system from heightened demand, Carvana noted that it will begin increasing operational capacity in Q4, but that it mainly is eyeing 2022, which may be giving CarMax a boost in the meantime. The main takeaway from all this is that used cars are still heavily sought after, as new vehicle inventories remain severely constrained. Although automotive manufacturing titans like General Motors, GM, and Ford F expressed optimism in late October regarding increasing new car volumes amid an improvement in chip shortages, dealerships are now starting to notice that the low vehicle inventories for new vehicles aren't really rising. For example, along with AutoNation, other large dealerships like Group 1 Automotive, GPI, and Sonic Automotive, SAH, they're down to 11 and 10-day new car supply. That's not a lot. A massive drop from the regular 60-plus day supply in 2019. However, although CarMax returned to excellent growth in Q3, indicating that it is still capitalizing on constrained new vehicle inventory levels, its ongoing underperformance in gross margins is weighing heavily on investors. With only 1 quarter left before CarMax begins lapping incredibly challenging comparisons, I would like to see better profit margins, especially at a time when auto manufacturers are struggling with shortages. What do you think about CarMax and their margins? Can you believe it? Their revenue is growing, but for each dollar they're investing, they're bringing back even less. All right, folks. That's everything that I wanted to talk about today. So I'm going to go ahead and wrap this video up. I do have just a couple things that I want to mention, though, before we say goodbye. And that is, number one, if you found this video to be informative, helpful, actionable, then click the like button. That lets YouTube know this video is worth a watch. Second, take the URL and share it everywhere. That tells other people that you think this video is worth a watch. And then number three, click the first link in the description below to become a Patreon member. We are going to set up a Discord for all of our members and a special group for Patreon members. And then the last thing to do, and if you haven't become a Webull user yet, do so today. You only have until Thursday to get this set up and done, and you will get 5 free stocks. Click the second link in the description, tickertimenews.com/Webull. It is also in the live chat right now. Click the link, sign up for an account, deposit any amount, $5, $10, doesn't matter, and then get 5 free stocks. That is free money, folks. So take advantage of that for the holidays. Again, that ends on December 23rd, which is Thursday. So make sure you take advantage of that before that offer expires. All right, ladies and gentlemen, thank you so much for joining me today. I'll be back tomorrow around 5 p.m. Eastern for another episode of the After Hours Show. If you are watching the replay of this, then go ahead and leave a ticker symbol and question in the comments, and we will go over it during tomorrow's live stream. Again, thank you so very much for watching, and I will see you in the next video.